Hey, Steve Saretsky here. As always, this is Canadian real estate market update with a particular focus on Vancouver. If you get any value or entertainment out of these videos, all I ask is that you hit thumbs up and subscribe. If you have any questions or comments, put those below and we'll banter back and forth. Quickly wanted to touch on really an overview of the Canadian economy, the role of central banks, and which ultimately play a role into real estate. I've mentioned this several times. A lot of people don't really want to do the research, or they get discouraged by maybe not understanding the impact of central banks and mortgage credit and all that. And it's really not that complicated. Like, if you can just sort of sit down and YouTube a few things and read some Google documents, like, you can figure it out pretty quick. So I'm going to try to explain it here, and it's really, because as I mentioned last week, the Bank of Canada plays a significant role in your house prices. It really plays a role in your entire life, whether you own real estate or not. They're basically setting the price of money. And so it should play a critical role. I think everyone should have some interest in keeping up to date with that. So as I mentioned last week, the Canadian GDP came in at 1.7% growth. That was below the Bank of Canada's forecast at 2.5%. It was for that reason that I said the Bank of Canada will hold on rates. Sure enough, last week or this week, they held firm on their interest rates. They did not move them up. They cited a couple reasons for that. Obviously, NAFTA being one of them, but the other one was really weaker home sales, recent government intervention, new housing policy. They wanted to see how those are going to play out, as well as mortgage credit deceleration. So mortgage credit growth, they said, has been decelerating for 3 consecutive months. That has them concerned. And so if you don't understand what mortgage credit is and what mortgage credit deceleration is it's basically a drop in demand. If mortgage credit is decelerating, it basically means that either banks are less willing to lend more money, or borrowers have less of an appetite to take on more debt, and that is ultimately reflective of demand. So if mortgage credit is growing, that means there's more demand. That means people are taking out more mortgages and investing that into the real estate market, which allows home prices to rise. So obviously, if you're, say, in Vancouver, where house prices have been growing by 20 to 30% on a year-over-year basis, you have to start to wonder, like, are home prices really growing 20 to 30% on a year-over-year basis because we haven't been building enough, or there's a little bit more population growth, or there's foreign buyers? It's a combination of all that, or is it because we also have historically low interest rates and banks lending more and more and more money? You take, for example, Surrey condo prices as of today are up 52% on a year-over-year basis. That's mostly a local market where they're really just speculating on higher prices, and their incomes haven't gone up by 52% a year. So clearly they're being lent money, and what they're ultimately doing is they're buying a payment. And because interest rates are so low and banks are so willing to lend because real estate can only go up, that mentality is driving home prices higher and higher. And it's all really part of a vicious cycle. And so, but now as you start to see mortgage credit decelerating, that signals basically reversal, and it's one of the two, whether people are taking on less debt or banks are willing to lend less. And I think it's lend less due to the mortgage stress tests coming in, tighter regulations, a little bit of higher interest rates. But that all plays a part. And so one of the things the Bank of Canada didn't mention is that mortgage credit growth not only decelerated for 3 consecutive months, it actually went negative in January, which is the first time it's done that in 6 years. So it's something they're obviously paying very close attention to, and that's going to, when the Canadian economy is the FIRE sector, which is finance, insurance, and real estate, makes up a record high 23% of your GDP, which is higher than the United States peak of 21.5% in 2009. Obviously, they're keeping a very close eye on the real estate market, because that has a major ripple through not only onto real estate, debt, but household consumption is driven by really a wealth effect from rising house prices. So they're all tied together. And so that's really what they're focusing on. Like I said, at the end of the day, to really summarize that, mortgage credit growth deceleration is a weakening demand and has the potential to create a household deleveraging situation. So the Bank of Canada is watching that, but they're in a very precarious situation because it's either they start hiking interest rates to protect the Canadian dollar, or they keep inflating the real estate market, keeping interest rates low and allowing these banks to continue to lend more. But that's also going to just destroy the value of the Canadian dollar. You're starting to see a huge drop in foreign investment into the Canadian economy, not just in real estate, but in all aspects. And so the Bank of Canada, I think, is going to have to, at some point, make a decision what they're going to do. I don't know what they're going to do, but I think at some point they have to really stand up and fight for the currency here. So that's coming from people that are much, much smarter than me. I'm almost just relaying what I've been told from really financially astute people. You know, this just all plays a role into that, right? I mean, the Bank of Canada has hiked interest rates. I mean, they printed a 4% GDP growth in July of 2017. Then they hike 3 times, and then all of a sudden your GDP drops down to 1.7%. Some people argue they've already gone too far. I mean, households are just so indebted that they can't afford higher interest payments. As you can see, on a year-over-year basis, as of the fourth quarter of 2017, Canadians spent 9% more on interest payments. And that doesn't even include the latest hike in January of 2018. So Canadian interest payments rose by 9% on a year-over-year basis. And so you can see as the Bank of Canada continues to hike rates, if they decide to do that, it's going to be a damper on asset prices such as real estate. And it's going to really affect household consumption because they're going to be paying more and more to service that debt. But at the end of the day, like I said, the Bank of Canada is basically cornered into a corner, and they're going to have to make a decision about what they want to do. To me, it seems like they've allowed households to basically borrow more and more and more, and as opposed to deleveraging in 2008, 2009, they just encouraged the banks to lend more money. They kept that going. As you can see, it's really becoming a situation where you're basically pushing on a string. Like, the households are really getting strapped to how much more they're willing to borrow, whether that's for real estate or cars. I mean, now you can go to an auto dealership and people are financing vehicles for a 8-year period. When, you know, how long ago, 10 years ago, maybe it was you'd service a vehicle for 2 or 3 years, finance a vehicle for 2 or 3 or 4 years. Now it's 8. And so, again, it just becomes a point where how much further can they take this? As you can see, mortgage credit growth on a year-over-year basis, it has been growing, but not to the extent that it was growing back in 08, 09. It's really, they're basically stretching households and how much they can take on. And I think it's reaching that tipping point where I don't really think there's much more room for households to take on. So I think the Bank of Canada is starting to realize that, but unfortunately, their unwillingness to really act on asset prices has basically forced the hands of, as I mentioned, provincial governments such as BC, where they've really had been in these very controversial policies that 2 or 3 years ago would have been completely unthinkable, to bring in 20% foreign buyers tax, a speculation tax, which apparently now, as we await all the details, could very well affect even people that are paying income tax in BC. So basically, what's happening, and again, we're still waiting on all the details. I don't know if they might reverse this, but people that own, say you own your principal residence in Vancouver, but let's say you own a seasonal cabin in Kelowna for the summers. You're going to get an income tax rebate for that Kelowna home, which you'll be able to then apply against the speculation tax, but that isn't likely not going to cover the entire speculation tax. So you could end up, someone basically gave a scenario where if you own $1 million recreational property and you make $100,000 income, you'd get about a $7,000 rebate on that speculation tax, but your speculation tax would be $20,000 annually. So as you can see, you'd have to muster up about an additional $13,000 annually just to keep that property. So it could very well affect people even earning incomes in BC and paying income tax in BC, but we'll wait to see all that. But again, I think I understand the BC government's precarious situation. I think that they've basically been passed sort of this hot potato. There's really no easy way for them. They were elected to bring action to the housing market, and they're doing that, and it's really because of, I ultimately come back down to is, well, obviously, yes, the previous government was very inept, but central bank policy has really created a disastrous environment for this to happen, and they've kept this experiment going for so long, where they now, again, have basically screwed themselves. So that's basically it. This might be a little bit more confusing, but I encourage you to go check out Professor Steve Keen. I'm going to put a link below to an article, a fairly short article from a couple economists that explain mortgage credit and explain how that impacts economic cycles, housing markets, etc. So check out that in the description below. All right, hope that helped. See you next week.